Okay, so RSI, for anyone, I'm assuming most of you probably know what that is, have used it. RSI is basically an oscillator. An oscillator is one that goes is up and down, oscillates up and down between 100 and 0. It never actually gets to 100 or 0, but it basically reflects the momentum. So if the momentum is bullish, you'll see the RSI start going up. If the momentum is bearish, the RSI will start coming down. Okay, and the basic interpretation that we learn when we first learn the RSI is basically your oversold, overbought levels. You're over 70, you're overbought, and you're taught that the RSI that it's showing bearish. There's a bearish signal there when the market comes back down. And here, when the RSI is below 30, there's a bullish signal when the market starts to rally from this low, from these lows here. Okay, that's the basic interpretation. Also, you have your neutral at 50. Okay, a little bit more advanced are your bullish and bearish divergences, which I will show in the next couple of slides. But hopefully we all know these basics, the oversold, overbought levels, and basically neutral, and so that we can start building more interpretations and applications. Okay, so 30 and 70 are our basic levels of overbought, oversold, and overbought. But there's a misconception. A common misconception is that when the RSI rises above 70, it is time to sell, and it is below 30, it is time to buy. In our previous example, we did see that here, for example, the market did reverse when the RSI rallied above 70, and when it came back down, that represented the market reversing. But that's not always the case. Even in the example on the left here, the left side of this example, we see that the RSI dipped below 30 here, but we continued to dip lower, and the price level also continued lower. So just because the RSI is below 30, that does not mean the market is ready to rally. Okay, so that's a misconception, and we need to unlearn that. Okay, and we see that as soon as we start applying this to the market, we start seeing that, and we should all realize that already. Okay, when the market reaches above 70 or below 30, it is actually a sign of strength, either bullish strength when it goes above 70, or bearish strength when it goes below 30. In the near term, we may have a sign that the market needs to pause, as it is in the near term an overbought or oversold signal, but that doesn't always translate to a reversal. Divergences help improve the probability that a top or bottom is forming, but can also be followed by continuation. So our basic interpretation of oversold, overbought, of looking at divergences, which here we have some examples here. We're going to focus on the RSI here as we look at this euro-dollar daily. Okay, I think we saw this example, this positive reversal example. Okay, and let's continue actually. This market continued to provide you with positive reversal signals, right? You have your RSI here, then you dip lower, but your price level is higher. So what you could do, and again, this is where the swing projection comes in. You have this RSI swing up here. Now match that RSI swing, okay, with the price swing, and you went up all the way here. Oh, okay, from this low here. I'm going to delete the previous ones. Okay, so now you have this swing. Sorry about that. You have this swing now. Okay. See, I'm being a little conservative and not using the entire swing up to here. Okay, but you can also do that. The reason is because the RSI here topped off, and I wanted to match the top here. with the price top. Okay, so that would have been here. Then you project it to your next pivot. So initially, this was our pivot here. Yes, that's our lowest pivot, so this is where we project it from. And when we had this candlestick action, that started the bullish continuation. Okay, and this would be your swing projection. Okay, so do you guys, or for the I can't see the full name here, but I hope that answered your question as far as how to do the swing projection for your positive and negative reversal signal. Okay, let's keep moving. Okay, so I want to show here a bullish divergence, right? Then your price, it still gives you a negative reversal because your RSI created a higher high, but your price high is lower. So here, you'll see that this is a failed example. For any type of signal, there is no signal that's 100%. So, okay. So you see what happened here. The market, with this candlestick coming down, showed that it was not ready to reverse just yet. And it suggested the market should rally at least to these lows and maybe even crack it. Okay. Now, price action did not do that. The market continued higher, and here we broke above these highs, so that no longer is valid. That negative reversal signal is no longer valid. And your RSI eventually here broke above 60, invalidating the bearish trend. Now we still had some sideways action, we still had some bearish attempt here, but the market has turned sideways. Okay.